Welcome everybody to tonight's investor chat. It's with Jay Patel. We're going to start the conversation in just a second. I want to let everyone know you can feel free to drop questions. We like to see them. I don't usually look at them while I'm talking because I'm not good at wearing two hats, but Adam will be keeping an eye on them. And if there's time at the end, we'll try to get him in front of Jay if we can and try to get his thoughts on some things. I am going to stop sharing my screen now so it can just be a conversation. And welcome, Jay. I think the first question I have is, can you just go ahead and kind of introduce yourself and tell us, who are you at a high level? And that's the place to start.
Yeah, I'll start there and then definitely dig into any parts you'd love for me to elaborate on. I'll kind of start with where I'm currently at. So I'm working in American Family Insurance over in Madison, Wisconsin. We're a property and casualty insurance company and primarily sell auto and property insurance products. But the views that I share today are primarily my own, not anything associated with the company. And so, if there is stuff that I allude to in terms of the great things the company's done, definitely want to highlight some of those things. But any views that I share on certain things, I'll definitely be sure to make sure that those are my opinions versus not the opinions of the company themselves. And so, in addition to that, I'm also I just recently transitioned off of the lead role for Shaper Impact Capital, and I'll definitely share more about that too as we get into the conversation. But that's been something that's really fun to build out and how Forrest, you and I connected in the first place in terms of just having overlapping interests and synergies with the work that you're doing with Uncrowd.
Yeah, thank you. So certainly first, I want to reiterate your point. So we avoid getting you in trouble with your company, but also occasionally we as we talk about investor things, sometimes the SEC has things to say as well, or nothing we say here is legal advice. Nothing we say is actual financial advice. We are two people talking and hoping to share that conversation publicly and hoping that some other people can learn from it. So thank you for clarifying that. And Jay, also thank you for acknowledging. So the way we met is really interesting, especially knowing how geographically close we are and how close our networks actually are without having overlapped. For some background, so with Uncrowd, for a lot of you that may or may not know, Uncrowd is a software platform where we work to connect underrepresented startup founders, so women, people of color, LGBTQ plus founders with investors. And the way that I got connected with Jay was totally cold. I was looking for we ended up on the same list of like companies doing cool things with venture capital in Wisconsin. And I had somebody reach out to me about it, and I was like, I don't know if this is it obviously was a real publication, but I think it was kind of just like an aggregator, like trying to kind of get clicks. But there was this company on there called Shaper Impact Capital. And I'm like, there's a impact capital company in Wisconsin that I don't know about. And so I start looking, and sure enough, on the website is Jay, and it says he's in Madison. And so I do the kind of like LinkedIn search, and I'm like, he's at AmFam? Oh man, okay. And then I see that you had time at the Impact at the Institute, which we'll get into in a second. But really, really small world. So fun to connect there. And truthfully, you've been nothing but generous and accessible with your time, which is one of the things that I truly appreciate when an investor is like, yeah, I'm happy to chat. I'm happy to know what's going on. So thank you for being here.
Yeah, absolutely. Yeah, I'm super excited to chat. And whoever wrote that article, thank you for doing that. You helped create a friendship and hopefully an opportunity for networks to collide. Because I think on one side of it, we run in similar circles in terms of the people that you know in Milwaukee. I feel like just looking at each other's LinkedIn and the mutual connections, there's definitely a lot of those. But really excited about some of the people that we may not have overlapping networks through, just to kind of bring them into the ecosystem in whatever way that we can. And that's what it ultimately comes down to at the end of the day, is the communities that we're able to build around these spaces and create opportunities for others.
Yeah. So first off, I love you saying that. And second, that is still a very atypical sentiment from my perspective, from a lot of venture investors. So that's a really good spot to, let's just start with your background. Like, can you give me, the short rundown of your journey to how you ended up here? Because for me, I think I think it's unique. I think it has led to some interesting perspectives from you. So please just kind of walk us through your background.
Sure, would love to do that. So I grew up in the Chicago area, have lived pretty much in the Midwest for most of my life. And the reason why I say that is because as I get into my story, I'll kind of share why I returned to the Midwest after living internationally for a little bit. So Chicago area, I decided to go to undergrad at Indiana University, where I studied entrepreneurship and management. My dad's he works in technology strategy consulting, but he's always been an entrepreneur and tinkering with things on the side. And so for me, that was something that I kind of just gravitated towards in terms of like wanting to be like pops, right? And so for me, I decided to study entrepreneurship. Indiana Kelley School of Business has a great program for that. And for me, the reason why entrepreneurship was so cool is because you learn a little bit about each function of business as you're kind of starting something from new. But then there's also corporate entrepreneurship where you're launching new products and services from within a large company, and just the whole aspect of thinking about growth and progress and fusing technology into that. It was just super fascinating and cool. So I decided to study that. Coming out of undergrad, I couldn't say that I was like dying to go into the insurance industry, and I've definitely gotten a much broader appreciation for just the social and economic value that the industry does provide. But it did take me a while to get there. But I was more so interested in the leadership development aspects that I would gain by being in a cross-functional rotation program that I was in. So it's called the LDP program. I had 3 one-year rotations. My first role was in product operations, where I got to learn the insurance business and how the product is manufactured and sold to markets, and all the stuff that goes on behind the scenes to help people kind of really protect the assets that they've worked so hard to accumulate over time. Um, if back when I was working in that first role, I probably couldn't have articulated them that way. That's the social aspects that I've really started to appreciate about the industry as I've continued to learn and engage in it. Second role was in innovation consulting, where I was working on building new products and services for the company. And that's where I got exposure to design methods and design thinkings. My former manager, he was a professor and still teaches or did teach for a while at the Institute of Design over in Chicago. And so really awesome in terms of understanding how to go through the ethnography process and really understand user needs. And I think that's translated really well into some of the things that I work on in terms of building that type of empathy now. And one of the things that I always struggled at during ethnography interviews, I know Nick has a bunch of experience in this space, but like one of the things that I always struggled with when I was gathering information was like leading the witness sometimes, because
Sure.
when you're out there trying to test your product and get user feedback on it, it's your baby in some ways. And so as you're collecting the user insights on it, sometimes I'd be like, oh, what about that feature? Didn't you really like that component of it? Rather than having the user kind of come to their own opinion and share that with us. So got really good coaching and feedback and practice and got better there. But my third rotation was in private equity, working as a private equity analyst, working on fund and direct investments in the infrastructure and real asset space, primarily timber and agriculture. And that role was super awesome because I struggled a lot in it. My background with entrepreneurship, I got exposure to venture capital and just general business acumen, but I didn't have the technical skill set to understand complex hedging strategies and other things that we were talking about when it came to investors that were pitching to us and opportunities that we were evaluating. So I tried to Google and read and learn as much as I could, and definitely got to a reasonable level of proficiency, but always felt a little bit of imposter syndrome as I'm trying to, work on the things that I'm reading about and apply them to the real world right away. And so I really enjoyed that role, but that's where I got exposure to impact investment at a high level. A lot of the deals that we were looking at increased crop yields, did great work around improving the perishable life of food and getting food to markets that need or that have supply and demand characteristics that would be favorable. And in my mind, always went to, okay, this is super cool in terms of generating financial return, but these are the same types of things that could be going into feeding hungry children all around the world in terms of the logistics and the infrastructure that we are looking at. And so my mind definitely appreciated the commercial side of the work that we were doing, but I was like, oh man, this would be so awesome from a social standpoint. But again, was still exploring and trying to understand the world a little bit better at that point in time. After that, my rotation program ended, and I was fortunate to secure a role within the company that I was working for. And I joined their internal management consulting practice, getting to work on general business strategy types of projects for business units, as well as some enterprise strategy things there too. And I got to work on a project with Gary as well, who's on the call. And he was a great mentor and someone that I really looked up to. One of the projects that we were actually, my first project that I was staffed on was trying to help the company understand its strategy related to foundation investments that I was making. And again, just the world seemed to like keep calling towards this whole impact investment thing. And I learned a lot, but I still had a lot more to learn. The field was super nascent. So this is around like 2013 or so, where you could. I try not to get in the argument of like what is impact investing versus what it's not. I think to each person, as long as they're feeling like they're having an impact, and I know there's a lot to unpack, which we'll probably get to there. But assume good intention, and it's been a space that's been around for a while, but I think it's now becoming more prevalent and mainstream. But at that time, I was still exploring, learning. I was on the board of directors for a couple of nonprofit organizations in the area, and one of them, which provides emergency shelter and services for homeless youth, they were actually looking and are continuing to look at potentially upgrading their flagship home that they provide for children. And a lot of the conversations that we were having on the board were, how are we going to finance this thing? And so I fortunately got the opportunity to help think about that a little bit. And that's where I got exposure to like, oh, what if we could go to the capital markets and raise some sort of note issuance or something like that. And that's where I just got more and more curious the more and more I learned about the space. But I knew that I would need to solidify my technical skills, not only on the finance side, but then also on the impact side. And now I think more MBA programs are starting to offer focused degrees in education on impact investment. At the time, there wasn't really much out there. So I kind of synthetically created my impact investment degree, if you want to call it that. I did a master's in finance at the University of Notre Dame. Super awesome program, really enjoyed it. It fit everything that I was looking for. And what was cool about it was taught by professors who had real life experience in terms of like running treasury units or corporate finance units. But it also had professors who were more deep in the academic side of things and really understood the roots of theory and why certain things were the way that they were in the financial field. And so we'd have one class where a professor's talking about the math behind derivatives, and then the very following day, it would be a professor who implemented a hedging strategy to take out the risk from commodities that they had on their balance sheet. So it was super cool, really awesome to learn. And yeah, please do stop me if I get it jargony at any
No,
point.
no, no, you're doing great. This is
Okay.
really good. No, I appreciate it. Keep going.
Yeah, so I appreciated the learnings there, and as mentioned, that was the finance side of impact investment that I felt like I really needed to get deeper on. But then there was also the impact side, which I didn't want to lose sight of. And for that, I decided to go to London and study at the London School of Economics for 2 years. And one, I wanted to study internationally full time if I had the opportunity to do so. I got advice to definitely expand my horizons and view of the world. And I was actually one of 8 Americans in a program of 80, and we were one of the most represented groups within that cohort. So it kind of just shows you how diverse the student body was. But then we're talking about things like public policy and economic development and globalization, and you have so many views from all over the world, and we're talking about something as far as like a research paper or case study, and then you've got a student from Brazil who's lived that and can speak directly to that. And so things like that were super awesome. The program exposed me to policy evaluation from an econometric standpoint. So essentially using statistics primarily and advanced scientific techniques around randomized control trials and things that are like the gold standard now from a policymaking standpoint to determine whether something is actually having a positive impact or it's perhaps something else that might be confounding the results. And that was a whole new technical field for me. I didn't have that type of exposure. I'd taken stats classes in undergrad and gotten exposure to econometrics, but nothing to the level that was out there. And so that was another technical skill set booster in some ways. And during that time, I also studied for, and about 2 years ago, so a year into to my full-time profession after London, the CFA program. So I received my CFA charter there. And so that
And
was a lot of work.
just to clarify, what's your CFA? What's the CFA stand for?
Yeah, it's a chartered financial analyst. It's a 3-year program. Well, it's 3 exams, and each exam, so the first one covers a broad range of financial topics at a really it's a deep level. It's both depth and breadth, but it's more formula oriented. The very first one. The second one is more of the same, but just much deeper into each topic. And then the third one is really primarily around portfolio management, where you learn again a lot about different financial topics, but the focus is a little bit more on wealth management and asset management.
Okay.
So that really helped give me confidence in terms of speaking about a wide variety of financial topics. And while I was in London, I interned for an equity research firm. So I got exposure to the public equities asset class. I interned for a venture capital firm that had a thesis around network effects. And so I really got to understand how the venture capital industry works at a much deeper level and what the day-to-day functions and operations are there. That summer, I interned for American Family in their business development area. I had the opportunity to get a really awesome experience over that summer. And after my internship was over, I loved the people that I met. I loved the work that I was doing. And for me, I wasn't quite sure exactly where I wanted to be and what I wanted to do in the world. And so I stayed in touch with everyone, but I went back to London and still wanted to continue exploring and seeing kind of what life had in store for me. And in that second year in London, I interned for the European Investment Bank as well. So that was a great experience there too. But as I was there, I stayed close with the team that I had worked with, and the leader of the group, he and I formed a pretty special bond over the course of that summer because we chatted about some of the social impact things that he cared about, in addition to the core day-to-day work that we were doing around mergers and acquisitions, which is something that I still continue to get involved in. But after that summer, when I was back in grad school, I chatted with him about my career plans, and he's like, what are you looking to do? Where are you looking to get experiences? And I was still really sold on the whole impact investment space being right for me, especially with all the signs that had kind of come up over the course of the last couple of years and all the work that I'd been doing. And one of the reasons, or one of the areas that I was particularly interested in around impact investment was the space of financial inclusion. So that journey of working in the insurance industry kind of led me to see the value that those types of products can provide. I think one of the things that we take granted living in a developed country is just the institutions that we have around things like insurance. Not all parts of the world have that, and many parts of the world have informal systems around these types of mechanisms. And it's a lot of family savings and community savings, and there's pools around risk sharing and just a general concept that exists, but nothing to the level of institutionalization that we have here in the US. And so for me, I thought I'd be in some part of the world like Africa or Asia, or a country or a continent that was a little bit more developing and nascent in terms of these systems, and either be a startup launching something to help bring that type of institutionalization to those markets, or be on the venture side, or investor side, investing in entrepreneurs who are doing more of the same from a financial inclusion standpoint. So insurance, banking, those types of services were kind of appealing to me. And so that's where I relayed that to the former person that I was working with, the leader of the area. He's like, why don't you come back to the Midwest and help us start this thing here around the Institute for Corporate and Social Impact at American Family Insurance. And I was like, yeah, absolutely. Where do I sign up? And another aspect of that too was a lot of the case studies that I had done while I was in London. My focus was on global public policy and economics. And some of those case studies looked at globalization back in the 90s and how what sort of impact that had on society. And so for me, being from the Midwest, having lived in the Midwest, and seeing these case studies around globalization where wealth creation is and continues to be awesome. But if you look at the data at a much more granular level, be deeper than just aggregate wealth creation in society, you start to see the heterogeneity of results where some people won and some people didn't exactly win from those materializations. And it's easy to say in hindsight, but had we had that type of foresight to think about what sort of policies and programs we could develop to help individuals, I think perhaps society will look much different than it does today. And as we think about what the future looks like now too, with things like artificial intelligence and automation and other technologies that are coming in that could significantly displace workers over time, like hopefully we have and are continuing to think about the right policies and programs to help individuals kind of transition into these new economies that are going to create new jobs and opportunities, but might require reskilling, retraining along the way to help us kind of prepare to get there as a society. And so long-winded way of saying, like, I wanted to be back in the Midwest and I wanted to work on some of these problems and get exposure to them, whether it was professionally in terms of what I was doing or with volunteer organizations and people that I was meeting and interacting with, and hopefully being a part of that discussion here. So took the opportunity, spent the first year working with the team to kind of build out the infrastructure and get us going with making some social impact investments. Really awesome experience. And then after that, was asked to take a little bit different of a role where I'm currently working with our corporate ventures group, American Family Ventures, which is pretty prominent in the Milwaukee area. And so I've really appreciated getting to work on that side of things too. But I've also, one of the reasons why I also took the role that I'm currently in is because I got kind of that like full stack of venture capabilities in terms of understanding what the front office looks like in terms of making investments and being out there in the field, sourcing deals and talking to entrepreneurs, but then getting exposure to the middle office in terms of portfolio management type of strategies, in terms of capital allocation and just the overall portfolio construction of balancing risk and return and all the other considerations that come into just running a venture business. And then also some of the back office stuff too. So really understanding the how valuations are done, or how the accounting process works, how to go through an audit, like things that are very easy to take for granted. But once you spend a year kind of working through the mechanics through those items, you gain so much better of an understanding of how kind of that machine works. And so getting to have that type of full stack experience has been super awesome. And I continue to get involved in mergers and acquisitions opportunities that we look at as a company. So my role has kind of shifted a little bit more from being in market, seeing stuff as far as what's going on from an entrepreneurial ecosystem standpoint, and into more of middle back office types of work, but then also a lot deeper into due diligence as we evaluate opportunities to potentially add to our company overall. And so that's kind of like the journey to this point. I know that was super long, but one thing that I didn't mention was my Shaper Impact Capital experience, and I'll touch on that really quickly too.
You do.
So Shaper Impact Capital is a group that's born out of the Global Shapers Network, which is a program of the World Economic Forum. And I'll make all these links in pretty quickly too. So World Economic Forum, based in, I think, Geneva, but definitely Switzerland, or international organization that focuses on bringing the private sector and public sector together to work on society's grandest challenges. And they have an initiative called the Global Shapers Network, and Global Shapers is it's a group of hubs that are comprised of around 25 to 30 young professionals in over 400 cities around the world. And Milwaukee's got a chapter, and I got really close to some of the people out there, and so Madison didn't have one. So I ended up starting one based on connecting with the Milwaukee group, as well as people that I knew in London and Geneva as well. But as I got involved in the Global Shapers Network, there was, so they do an annual conference in different regions around the world. And so the Southeast Asia region was hosting their conference back in late 2018, early 2019. And at that conference, a group of people were like, hey, we've got all these investors in our network that are working at venture capital firms, and we've got a bunch of entrepreneurs in our network who need access to capital. Wouldn't it be awesome if we created some sort of platform like Uncrowd, or just a way to bring people together to help entrepreneurs that need financing get that type of financing and kind of bridge that network. And so that was kind of the genesis of it, and also focused on social entrepreneurs too, who are solving meaningful problems in the world to tackle. And so that started around January of 2019. I learned about it around February of 2019, just through communications in the network. And so I reached out to Chia, the person who got that up and running. And I was like, hey, I'd love to learn about this initiative. Is there anything that I can do to help? At that time, I was a couple months into the new job and trying to understand the impact investment space and get to know people. And so thought that would be a great opportunity to, one, build my network, but then two, see if there were synergies in terms of helping these entrepreneurs around the world who needed financing to get that type of exposure. And I was also studying for CFA level 3 at the time, so I didn't really have much time to give to be able to build out the nuts and bolts of it. But I was like, I'd love to stay in touch, see how things are going, and if the time is right, and as the group kind of grows and develops, I'd be happy to play whatever role that I can to support the team. And so Chia and team did an amazing job of growing in the Southeast Asia region. They expanded into Europe. And I think Southeast Asia and Europe or I should say Asia and Europe, were the two primary geographies at the time. And I reconnected with them in June before an Atlanta event that we had for the North America and Caribbean chapters of Global Shapers. And they're like, we don't have anything in North America, but that's something that we want to build out. Would you be interested in doing that? And I was like, yeah, absolutely. Would love to help and support in any way that I can. And that's where I got connected with Sam Martinez, who is in Atlanta, and he showed me around the Atlanta entrepreneurial ecosystem. So I got to meet a lot of really cool people there. But then he was super interested in helping set this thing up. And at that time, we recruited like 7 to 10 individuals that were part of the core working team as we got things running. And so I haven't shared what Shaper Impact Capital is. So it's our product is primarily a newsletter that features different social entrepreneurs who are looking for mostly I would say pre-seed and seed type of financing, so their first institutional investor, but it differs based on what market individuals are in. So we've got a group in Africa now, and some of those some of those startups are a little further along in terms of their financing that they're looking for. Similarly with the startups in Asia. So we're trying to figure out what our niche is in terms of where we could best support the entrepreneurial community and really help amplify entrepreneurs who are looking to have their business do some sort of positive impact in the world. And we align ourselves to the SDGs in terms of the framework that we use for social impact. So we
Hey,
ask.
can you elaborate on the SDGs? What are the SDGs?
Yeah, so the SDGs are Sustainable Development Goals. They were put together back in 2010, I want to say, at one of the UN conventions, and they've been iterated on United Nations conventions. They've been iterated on over a period of time, and there's, I believe, 17 of them, but each of them focuses on a different area of impact, let's call it. So some focus on the environment, some are around inclusion, some are around justice. And so what the SDGs have done is created a framework across different countries to evaluate progress on these items that the UN has determined as being important for building a better world, for lack of better words. And so these SDGs, within them, there's specific definitions and measures that are being tracked as well to kind of evaluate progress in terms of how we're doing as a world in terms of pushing the needle on some of these items that are super important. And so yeah, that's the framework that we use. And there's so many different impact frameworks out there for anyone that's kind of done any sort of searching on the space. And I'm happy to share kind of my thoughts on those impact frameworks, later in the conversation. But that's where what we look to do is we have an intake system where entrepreneurs can submit a form on our website, and that form just tries to get to understand the business a little bit better. And we have a team of we call them analysts, venture analysts, that go in and work with the entrepreneur to help assess their business and determine whether it's a right fit for the newsletter. Fit is pretty important screening criteria in terms of what sort of audience we have in terms of who's looking at our opportunities. And hopefully we're able to talk about this later too, but not every entrepreneur needs venture financing. And that's something that we have a lot of conversations about and want to continue exploring and expanding opportunities to find those pipelines of financing that are appropriate for entrepreneurs, but also making sure that we are living into kind of the purpose of the newsletter that we've created around who the audience is that we're targeting in terms of potentially getting financing for these businesses we work with. So the analyst team kind of has a couple conversations with the entrepreneur, tries to understand the business a lot better. And if there is that right fit, then we'll look to feature them on the newsletter that's published. And that one gets published once every 2 months. And if you haven't checked it out, for us, hopefully we're able to share a link to the Shaper Impact Capital website at some point. And if the company, if there's a little bit more work to do in terms of getting what we call like investor ready, so ready for a conversation with an institutional investor that is going to poke and prod and really dig into some of the details around diligence, we'll try to help that entrepreneur. And what we'll look to do is support from a financial modeling standpoint. And in early stages, it's very difficult to like build a financial model that can really forecast out multiple years, but that's an important part of the process in terms of understanding the business, understanding the market, and just the numbers behind what is trying to be accomplished. So we'll help try to frame those conversations and provide that type of guidance as appropriate when working with entrepreneurs. But then given that our target is also really about the social impact those organizations are making, we also have a team of people that are kind of specialists in the industry in terms of impact evaluation and social impact measurement. So we'll try to work with the startups to think about what sort of impact frameworks and things that they might be able to start incorporating now to build the data infrastructure to measure and collect these items in the future, because some impact investors might find them as core components of their diligence as well.
Yep.
And so we want to make sure that these entrepreneurs we're working with are ready and equipped to have those conversations. And then the other area that we found useful in terms of supporting entrepreneurs is around pitch deck creation and storytelling. So we'll try to and certainly the entrepreneur knows their story of their business better than anyone else. So we'll try to kind of play more of that coaching advisory role of saying, here's how an investor might interpret this item or that item that's in your pitch deck. What if we tweaked it in this way to make it a little bit more in line with the message that you want to communicate, but gets the investor perhaps what they need or what they're looking for in terms of understanding traction and kind of evaluating the progress of the business. And so
that right there is specifically a really good gem for founders, which is like there is more performative action in terms of pitching, but I use performative loosely. What I mean is just there's little things that you can tweak to understand your audience better and to think about like exactly what you're saying is I've gotten pretty good at like hearing pitches from an investor perspective where like I know those kind of like red flags or those points that are like, oh, that's going to leave a question, like answer that. And so if you are pitching, if you're a founder pitching or getting ready to pitch, one of the best things you can do, and frankly, like it's secretly a good way to also raise money, is to just ask for advice on your pitch deck from investors. Like have them ask if they will give you some time to like pitch practice with them. And take that feedback from investors, because they're going to tell you what investors are thinking, which is going to help you frame it, and B, you secretly get to pitch.
and I love that advice for us. And the thing that like it makes me think about is I've been doing a lot of, so how do I phrase this? So if you think about the book like Outliers, Malcolm Gladwell's book around getting a whole bunch of practice and being in the right place at the right time kind of leads to success down the road. Or maybe mindset's a better example. So Carol Dweck, she published a book on mindsets where it's about growth mindset and fixed mindset. And the fixed mindset is really about like having a little bit nervousness and anxiety to go out there and do something because you might end up failing at it, and having that preclude you from going out there to get the practice and saying like, oh, this sucks, like investors don't understand it, or my idea isn't as great as I thought it would be, or whatever variety of reasons that you're able to come up with. Like that's one approach to think about pitching and going through the process. And then the other approach is more around the growth mindset, where it's like embrace the suck kind of. I think Brene Brown says that.
Yeah.
It's like pitching, it should be a fun exercise, but it becomes more and more fun as you get better and better at it. And the only way to get better and better at it is to keep practicing. And so I think about like standardized tests that I had to take for entry into grad school. Like when I first took the exam, I did very bad. And then I kind of just knew that I wanted to do well. And so I kind of put my nose into the book and just did a bunch of practice problems over and over and over again. And I started to see what my weaknesses were and where I had opportunities to improve. And with the test, that was kind of like a feedback loop in terms of telling me where I was doing well versus where I was kind of struggling. And so to your point, Forrest, the more practices that you're able to pitch in front of people, and it doesn't even need to be an investor sometimes, it can be like an author that can give perspective on your story, or like anyone. And the reason why I say anyone is if you can't explain it to someone very simply that's like not an investor, there's the risk that you could pose that maybe the investor doesn't get it in the 30 minutes that you have in your first pitch with him or her. And so
30 minutes for a first pitch, you're very generous.
Right. Yeah, no, it's important. I think building bonds is like very important in the entrepreneurial ecosystem, and having the opportunity to pay things forward for people that spent time with you as you were learning and growing. So like, I didn't know everything about ventures when I first got started in the space, and I still don't know everything. Like, I learn
Right.
something new each day. And so getting the chance to spend time with people, and not everyone's going to be willing to make the time, but those people that are, um, you know, definitely try to soak up as much information as you can from them. Take everything with a grain of salt, because everyone always wants to give advice, and even for me, I might not give the best advice on something, and certainly hope that you're, as an entrepreneur, able to go out there and prove me wrong on an assumption that we disagree on. And the best way to do that is go out there and get market traction and be like, hey, I just hit $1 million in revenue, you were wrong. and,
Yeah.
and it's hard to predict what that future looks like. And so hopefully you don't tell me I'm wrong in that way, but
Well,
I do hope I am wrong.
it's interesting you say that, especially just in terms of getting reps. So one of the things we talk about a lot in this conversation, and just to the uncrowd audience in general, is about like kind of just working to get comfortable in the room with investors, like feeling, because there is the inherent power dynamic. Like you're asking for money, someone has it, someone else doesn't. But aside from that, like it's just a human on the other side. And just even if I'm reflecting, because I was pitching somebody earlier today, and as you as a founder understand the investor side better, it really removes a lot of the emotion from the conversation, if that makes sense. Like your product is your baby, and you're emotionally tied up in it, and this investor just pokes some good holes, and like I was just like, yeah, those are really good points. Like those are the right things you're supposed to ask. Like I disagree, to your point. Like I disagree. I'm working to disprove that point, but it's a good point. Like, and it hurts less once you get to that place where it's not like everything rides on every single conversation, because you just understand how all the dynamics work a little bit better. So
Absolutely.
pitch everybody all the time.
Yeah, and one thing, of course, I think that you mentioned that's really good to touch on too is like, don't think about pitching as a transactional opportunity. See it, and again, this is my view on it. I would try to see it as an opportunity to start building a relationship with someone,
Yep.
because if you're able to talk to the investor and they give you very pointed feedback in terms of like, hey, I can't invest in this because here's what I'm looking for, and I need you to be at X, Y, and Z before I can seriously look at this because of the stage that I'm investing at, or what my investment committee is going to be looking for. Nothing's like a one-person decision ever. It's kind of a group decision. But that's where you have the opportunity to build that relationship with that investor and get feedback, and check in every quarter or so to share progress in terms of, here's how I'm doing in terms of achieving that milestone that you had set up for me, and here's what demonstrable progress looks like. And when you're out there raising your next round of financing, that investor, you might be a much better fit for them. And if you've already done the legwork of building a relationship and creating that trust with them, the process is so much smoother versus having to restart the process all over again when you're transactionally again looking for financing.
Your first pitch is to open the door, not to close the deal. The way that I talk about it is like it's a data point. And if 0 is you're just meeting and 100 is the day an investor invests, your goal is to give as many data points as you can to build you up to that point. And each of those interactions becomes one data point that is a positive, hopefully trending positive toward that one day investment. So you're totally agree with you there.
Yeah.
So as you know, Uncrowd was built to support underrepresented founders. And when we look at the demographics on the VC side, overwhelmingly white male. We also see, mostly coastal. I believe the last metric was 40% went to Harvard or Stanford, which is a large swath. You are in the Midwest. You're not a white guy. You didn't go to Harvard or Stanford. Can you speak to your experience as a VC? What your from that perspective? What has it been like? Have you felt that conflict, or have you felt? I'll let you speak to it in the way that makes sense to you.
Yeah, yes, but Yes, but
Okay.
and so on the yes side, certainly going to Harvard, going to Stanford, being a part of certain networks, that's based on historical data and evidence that increases your probability of success in terms of building a business that we would deem successful by conventional standards these days. And so in that sense, not having that specific like linear path to ventures, it does create challenges and doesn't get you into every single door every time that you're looking at doing something in the space. But the but component of that is I have been pretty privileged in my life in terms of like the institutions that I have gone to and the experiences that I have gotten and the mentors that I've had and the people that have helped me bridge the gap into the broader space. So like, yes, it might not be that like linear path of working at a top firm and going to that top institution that's known specifically for this industry. Um, but I have kind of built my own world within it through the people that I have connected with and continue to connect with. And I think the cool thing about ventures, especially over the last couple of years, is it is starting to become a little bit more accessible to all.
It is.
And yeah, and I can't say that I have been in the like, so I was in a leadership development program, and and this was like a week ago, 2 weeks ago, someone said something so profound that's really like stuck to me and something that I really want to like think about more deeply as I progress in my career. They said you have to be it's not good enough to be unintentionally exclusive. You have to be intentionally inclusive. And so I think that has and needs to start permeating a little bit more in terms of the industry. So I don't think I've ever been in a situation where I've felt like someone has excluded me from something for whatever reason. But there are instances where maybe someone could have reached out a little bit more when I had tried to connect with them and been a little bit more inclusive on that side of things. And I'm fortunate again to come from a privileged position where I get warm introductions to people that have gone to Stanford or Harvard or working at some of these top firms. So I don't want to like be unempathetic in that sense of things, because there are other individuals that come from different walks of life that are excluded in certain conversations because of what institution they attended or where they've worked or professional background. And those are certainly things that need to be overcome for us to continue progressing as a society. But I think on the other side of it, we need more people that are more intentionally inclusive and reaching out to that founder who is starting their business for the first time, that hasn't gone through a fundraising experience, to say, hey, I've looked at hundreds of companies like this before, and here's what that experience has taught me, and here's what I can do to include you in my network and this network and this process that's obscure and you might be going through for the very first time and feel a little bit lonely going through. And so I think that type of leadership is it continues to be warranted in this space. And I know more organizations and institutions in the venture community are starting to focus on that, which is extremely positive. But I hope it's not one of those things that's a trend, but something that people really care about and have good intentions on, just because it is needed. And the more opportunities we have to solve society's greatest problems through this super cool thing known as entrepreneurship, the more diverse perspectives we bring into that problem solving, and the more opportunities we have to create solutions that customers are actually willing to buy and are able to afford too. I think that's a big component of that as well.
I think that concept of being intentionally inclusive is really powerful. Or that I have had people that have reached out to help me without me asking, and and it does feel different. It feels it feels more powerful. I think from a founder perspective, the thing I would say is that I do think it is rare still to find someone that is going out of their way. With that said, I don't think it is rare to find someone that is happy to help if provided the context. And so I would err on the side as a founder of reaching out and asking for help, because I think you will probably find a higher hit rate than you might think. I think a lot of investors truly want to be helpful. I know that that's a little bit of a cliche of like, how do I help and how can I help? But a lot of investors I know, a vast majority truly want to be helpful. Like they enjoy startups. Like it's why they're in the space. They like entrepreneurs. They get energy from those individuals. And if they can be helpful, they will. So I really do encourage, find that next data point, find that data point of asking for help and build a relationship with investors who might someday open the door for that next big growth cycle for you.
Yeah. And to that point, Forrest, like, I don't think investors like intentionally like don't respond to email or whatnot. Sometimes just everything gets so busy and it's tough to like keep up with many people that are reaching out. So I would recommend like definitely trying a few times. And I think the one thing that I really like about Generator, who you might be familiar with in the Madison Accelerator program, they encourage, and I think they encourage their entrepreneurs to have newsletters that provide updates to investors and just general people that want to support their company. I think that's super awesome way to reach out. That's low touch of going to an investor and saying, hey, I'm putting out these updates on a quarterly basis on my company. Here's what we do. Would you mind if I subscribed you to my newsletter to keep up? And I read those for the ones that I'm subscribed to when I have time to do so, of course. And it's like, oh yeah, I remember speaking to this entrepreneur at that pitch event. I wonder what they're up to. And I'll see that. And if there's anything on their newsletter where I can be like, oh yeah, maybe I could help with this. I know this person in this industry. I'll definitely like shoot back an email or something if I have a chance to. So like, yeah, definitely like try to build those touch points, as many of them as you can. But if you aren't able to get that like successful hit rate on the first time you reach out to someone, don't be afraid to reach out a couple times. But then do definitely get the hint when someone is and continue on the chat.
I know you mentioned when you were talking us through, so your resume is robust and even at a fairly young age. And I don't call that out to say like, how'd you do it when you're so young? What I want to talk about though, is it does seem like you had either an intense focus and or a calling for this space pretty early on. Where did that come? Like, why? It's such especially knowing that you cared about like social impact investing back before there was barely terminology around social impact investing. How did this happen for you?
Yeah, I kind of went through like a little bit of a quarter life crisis, if we want to call it that, where I was, and I still feel like I do this sometimes, but I'm getting much better at it. So the thing that I kind of struggled with was like, do I build a very broad set of skills or a very deep set of skills? And for me, I really latched on to IDEO Tim Brown's T-shaped thinking, where it's like you have a bunch of horizontal skills. So you know a little bit about a decent amount of things, but then you have one vertical skill that you're super good at and can really leverage for whatever situation that you're in. And so I wanted that T to be, I kind of wanted it to be like more of a pie, I guess, where one side was the financial skill set and then the other side was the impact evaluation skill set. And after just getting that approach to building out technical skills in that way, I feel like I keep wanting to add different verticals and have to stop myself when diving too deep on something to be like, okay, this you need at a surface level. You don't need to like know everything about it. But it's just that intellectual curiosity, I guess, that kind of keeps me interested and engaged. But back to your question more specifically about the impact investment space, I was kind of evaluating like, after having gone through rotations and built a pretty broad skill set, like what was I going to start focusing in on and feel like I was getting better at in terms of creating a career around. And that's where the impact investment space kind of um, it hit that. So you're familiar with the Ikigai framework,
No.
the Japanese one?
Mm-mm.
It's four circles, and I'm going to get this wrong because I haven't looked at it for a while, but it's like a Venn diagram,
Okay.
and it's around what can you get paid for, what do you enjoy doing, what are you good at, and what can help the world.
I do know that framework. I didn't know that
Yeah.
name. I do know the framework.
Yep. And I hope I pronounced it right. But like that intersection for me, that was, or at least what I was trying to build towards impact investments.
Sure.
And so that's where I realized I would need to build strengths in this space to be considered seriously as a candidate in job interviews, because I knew it was going to be super competitive. And so fortunately, I was in a situation where I was in the right place at the right time, where everything kind of just worked out the way that it did. But I think that was kind of my driving framework that I came up with at that quarter life crisis, where I was like, shoot, what am I going to do with the rest of my life now? And it keeps changing too. So I'm continuing to learn about more fields and things that I'm interested in, and different ways to potentially use the things that I've learned to help the world.
Well, that's a good segue to just talk a little more broadly about impact investing. And you've kind of hinted at this, so I'm going to start with it. How do you define impact investing? This is a terminology that we see used sometimes a little fast and loose. Some people create
Yeah.
their own definition. So how do you personally define it?
Yeah, it's funny because like I went to a couple impact investing conferences back in like 2015, 2016, or around that time. And that was the focus of like every single panel discussion is like, what is impact and how do you define it? And I think for me, impact is improving the status quo. And one of my professors in London put it really well. There's like an unjust equilibrium that exists in the world, and impact is trying to get that unjust equilibrium to be a little bit more just in that sense, and creating a sense where there is social um, order and opportunities for people to achieve what they need to, and for what we need as a society to function effectively. So for me, impact is really changing the status quo in a positive way. And I know there's so many definitions, like you were saying, Forrest. And so I've become less critical of anyone else's definition of impact, and kind of hold mine to myself. But I appreciate all views of impact, if that's fair to characterize.
Do you and I ask this as somebody who's a little bit jaded, a slightly jaded, do you feel like traditional venture markers can work for impact investing? Like I think using capital to create an impact is absolutely beneficial. I do see some things that become a little bit problematic when we start to apply traditional venture markers. I'm curious, and I should clarify, when I say that, I mean, quick 10x plus returns on your investment, usually looking for high growth in a hurry. So thinking about things that way, I'm curious to get your perspective on that.
Yeah, this is one of the things that I've struggled with personally and intellectually, as a human being, I guess. For me, like the venture model is so awesome because it creates multi-generational wealth. The venture model, as we're describing it, right?
Yeah.
In the book Disciplined Entrepreneurship by a professor at MIT, Bill Ollett, puts it really good. So there's like two types of businesses. One's exponential growth, which is more digital types of enterprises. And then there's other businesses, which are entrepreneurial ventures. So don't want to discount them at all, but they're more linear growth businesses that just have a different growth trajectory. And so as we're talking about it, I'm kind of framing this on the exponential growth businesses.
Yep. Perfect.
And again, they can provide multi-generational types of wealth for many individuals that are on the capitalization tables of these businesses that grow and end up being successful. I think one of the things that I still quite haven't figured out yet is the wealth distribution or accumulation of wealth when it comes to those types of models. It's one of those things where I'm always interested to know what an organization does with its profits at the end of the day, or even at a lower level, its free cash flow.
Yep.
So those decisions around how to reinvest are something that like I find really interesting. So if you're generating a whole bunch of cash flow, could you have paid your employees more with that? Where your yes, your cash flow generated from a bottom line perspective is going to be less, but your employers are, or your the people that are working for you are doing much better and much more well off. And that's excluding assuming that people have like stock options or other things in the
Yep.
business that align interests in that way. Um, or on the other side of it, like, could you be charging less to your customers and making your product more accessible to individuals who might not be able to afford it? And again, that has an impact on your bottom line from a free cash flow standpoint. So like those are the types of things that I think about when it comes to the overall venture model and the tensions that it has with potentially doing even more than maybe it could be right now. And I also like one book that I read is called Scale by Jeffrey Moore, I think it is. Yeah, I think it's Jeffrey Moore. But that book talks about the growth of cities and biological organisms, and looks at the exponential model versus the linear model. And this is like a little while back, so I might not get this exactly right. But it suggests that in certain instances, the exponential model potentially creates more waste. So like if you're thinking about biological organisms, as they grow larger, the energy they consume and the waste they give up ends up being much higher. And so when it comes to a city, the faster a city grows, the infrastructure around it may not be able to grow fast enough from a policymaking standpoint, from a physical infrastructure standpoint. And because of that, you have instances where there's poverty, there's social issues, there's environmental issues, and the things that come with growth that's too fast. And Jeffrey, I think it's Jeffrey Moore, but in his book, he also equates that to like businesses too, where if they grow too fast, then you have instances where maybe you don't have the right procedures or policies in place from a system design perspective. So you run into moral and ethical issues when it comes to scaling up the business, or you don't have the right cultural practices that can scale up with that quick of growth, or you don't have the right HR infrastructure to add people and work effectively in a larger team relative to the smaller team that you were on. And all of that stuff kind of creates waste that has to be dealt with at some point in time as the business grows. And so like, I don't want to say that I'm against exponential growth and the venture capital model in any way, but like those are the things that I think about in terms of what are the negative externalities or impacts that materialize from that super high growth, and what are things that we could be doing to potentially alleviate some of those items. I don't have good answers for them, but more intellectual curiosity in that sense.
Yeah, it's a tricky thing. It's a tricky thing we navigate a lot with Uncrowd, which is fundamentally we don't actually think of ourselves as an impact organization. Like we are helping founders who don't have capital. But if we spotlight female founders, for example, they get less than 4% of venture funding. They certainly are not represented equally or proportionally to the population. So is any investment in a female founder an impact investment? Regardless of what their business is, regardless of what their product is. And it's something that I don't know the answer to, but I think about frequently. I'm curious, like how do you frame that?
Yeah, and I think that goes back to my definition of impact. Like
Yeah.
for me, again, changing the status quo in a positive way. So that counts.
Okay.
But I think when it comes to like others, there's certainly going to be I'll make 2 points on this. There's certainly going to be the risk of potentially impact washing. So greenwashing used to be a term before when people were working on environmental practices, but then they found out that they weren't really doing so and were just using it as a marketing ploy. There's certainly a risk of that when it comes to the whole impact space, and you hope everyone's being authentic with their motives and always assume positive intent. And I think when it comes to impact investment, that's what distinguishes impact investment versus general investments. And hopefully we're able to get to a point where they're all one and the same at some point in the future. But that intentionality pre-making the decision to invest is super important in terms of what's being screened for and what's being evaluated in that conversation before the capital is deployed. And I'm non-judgmental in terms of what people want to consider impact. Like everyone and everything, everyone can define impact in whatever way that they want, and everything kind of falls within the scope of impact for me, to the extent that those individuals are hopefully being authentic, and again, that's assuming positive intent, and also before deciding that, making it a part of the decision process intentionally.
Who do you look up to in the space? Like, who do you feel like is doing great work in impact investing right now?
Yeah, I I've always had an affinity towards foundations. Um, and and the reason why I say that is, and I think more and more foundations are hopefully going to start transitioning to this model, but you've got the 5 and 95 model, where the 5% is grant or capital of assets under management that needs to be deployed back into the community. But then the other 95% of assets under management can be run kind of like a hedge fund. And
Sure.
so some foundations, they might, and I think we're getting better at calling out foundations on these types of practices. But some foundations might be really advocating for, let's just say, environmental justice, for lack of a better example, or yeah, let's say environmental justice. But then they might be investing with their 95% in an ETF that has a company that's running a pipeline directly through a community that's a marginalized community.
Yes.
And how is that environmental justice at the end of the day?
Yep.
And I think that type of like paradox, I don't know, paradox might not be the right word for it, but that type of like misalignment between financial return and social impact, like that's the stuff that I think we're gonna see hopefully start becoming less prevalent. But for me, the organizations that are able to align their impact with their financial return are organizations that I admire, but also being realistic about that too, where they're building holistic impact strategies across all asset classes and not just one asset class, or focusing specifically on like not taking more of a narrow view. So I really like Huron Foundation, Clara Miller out there. They like were the OGs in doing some of that stuff. They moved to 100% mission aligned portfolio on working things around economic inclusion and addressing poverty. And they have, again, a broader asset management strategy that's impact oriented. So I appreciate organizations that are able to bring impact into like the overall investment strategy versus different components of it.
Um, this one I'll ask you for advice and secretly hedge it as a question for you. One of the things that I've thought about is what happens for me after Uncrowd, because I don't know that there's a version of work that I can go into that doesn't have this impact focus. I can't, or at least I can't turn it off. Or I can't unknow these things. And so how do you handle your corporate venture job, which is about, you have you have a fiduciary responsibility to find opportunities and get returns there. How do you turn off that social impact side? How does that work? Like, how do you reconcile that?
Yeah, that's a good question. I mean, I think the cool thing about American Family overall, so not talking about the venture portfolio, but the overall institution, is it does really care about those issues in the community, and you see it permeate throughout the organization and the culture. And so for me, I've found a really nice balance of being able to work on those things that are related to corporate strategy and improving our bottom line, but then having so many opportunities to volunteer and even get paid for some of the talents that I have on the impact side of things, and the full set of capabilities that I'm able to bring to the table. And so I think um, part of it is having the opportunities for that to exist within the infrastructure of the world around me, but then the other side of it is going out there and like finding those opportunities too. And so if I was in a role where it was purely like a, let's call it a profit maximizing opportunity where I'm doing nothing but improving the bottom line, and again, for lack of a better example on this,
Understood.
um, I would look to outside of work find opportunities to get involved and stay involved in the space, whether it's mentoring entrepreneurs or trying to work on a side hustle or volunteering with a nonprofit organization, some way to kind of fill that internal void that I would have. And again, ethically, I probably couldn't um, compartmentalize both items where like I'm destroying the world on one side and on the other side trying to save a little part of it.
Yeah,
For me, I'd have to find ways to kind of integrate both. And if I couldn't do it in my professional work that I was doing, I'd probably kind of feel a void or a hole, and would try to figure out how to best address that.
that's great. I'm going to shift into some of the common questions we hear from our founders from Uncrowd, just to get your perspective and hopefully they can take something away. Two most common questions I get from founders: how do I know if I'm ready to raise capital, and how do I know how much to ask for? So this is early stage, first time raising. What are the signals you're looking for as an investor that A, this person is venture ready, they're ready to be invested in, and B, that the however they're calculating their valuation when there's little data early on is in line? How are you factoring that out?
Yeah, I think Joe Kyrgyz from Generator put it really well when he gave a talk on understanding venture capital. Um, Venture capital is like jet fuel, and you need to really be ready to kind of take that on. Um, it's a lifestyle change. You're going to have investors that you're reporting to that have expectations, are super demanding, and want to see your business succeed, but also want to see you, putting in your effort to help it get there. And so that's one thing that I think entrepreneurs just need to be ready for is just the expectations that come with institutional financing, especially a founder that's never gone through the process before, because it is certainly demanding. Um, when it comes to knowing that you're ready for it, I think getting to a point where you have customers, and again, this depends on which investor you're chatting with at the end of the day, and this is my view from the types of businesses that I personally like to see, is I don't like taking market risk in that sense, where if someone's out there going to spend a whole bunch of money on building a product that has never been tested with consumers and you don't know whether people are willing to pay for it or not. I'd love to see like iterations of a product where it gets to a point where you have paying customers. It might not have the full feature set that you're looking to launch, or it might not be perfect from a development standpoint, but you're collecting really good user feedback, and you have a backlog of things that you want to add to your product and your customer, and those things are coming from your customer, and you have a nice pipeline of opportunities where if you do these things and as you're doing these things, you're able to increase your customers accordingly. So that's at the earlier stages where I think venture investment becomes feasible and interesting. When it comes to finding product market fit and really getting ready for that jet fuel to come into your business, having a customer base that has demonstrated that you've demonstrated the ability to scale, but now you need growth capital to really go out there and acquire those customers. So really focusing on the marketing, customer acquisition side of the house, that's when another time when you're really ready to go out there and raise. Because that assumption is that when you spend on that marketing and are able to gather those customers, your trajectory from a revenue standpoint, it might have been going like this, but then the expectations are that it'll start hockey sticking up and really, really, really grow. And to the extent that you start seeing that with some of the smaller rounds or capital that you invest into growth and marketing, the more you're able to build a case to investors that, hey, if you provide this financing, this thing's going to take off. And here's the data that suggests that I think it's going to take off. And again, that depends on what stage you're at, right? So like seed and earlier is really about product and demonstrating that traction and finding product market fit. But once you found that, that's when you want to be scaling that thing up pretty significantly. And part two of the question around how much to raise, I think it's really hard to, I'm more of a finance guy, so I like seeing models and really diving into that side of considerations. It's tough to project what revenue is going to look like. You can certainly make plausible guesses and build in scenarios on that, but you can probably understand your cost structure a lot better than you can understand the top line component of it. So the thing that I like to do, or the mental model that I like to put on it, is understanding what that variable cost structure looks like, as well as the fixed cost structure, and trying to forecast out for a 18-month period. I think that would be reasonable, anywhere from 12 to 18, to have sufficient runway to achieve your goals in terms of what you want to achieve over that period of time to get ready for the next round of financing. And it's kind of that, so like, if you get capital day zero and we look at it 18 months later when you're at your next round of financing, what's that story that you can tell investors over that 12 to 18 month period of how you've grown the business, or how you've learned about your customers, or whatever might be warranted to secure that next round of financing?
That's a really good answer. I appreciate that. That's actually super pragmatic to think about it in that way, which is not, if you Google how do I go through and do a startup valuation, you're not going to get that piece of advice you just gave in that way, which is useful to kind of break out variable versus fixed costs and use that to kind of make a smart projection. I appreciate that. Yeah. On the founder protection side, how do when you get to a certain size, almost all the variability kind of disappears, right? Like all the data's out there, so the times when founders are the most vulnerable is the times when they're the least informed at the very, very early stages. What's a red flag? And again, founders also very rarely have the opportunity to vet their investors, let's be honest, especially early stage. Very rare are you in the position where you have checks coming from multiple angles and you get to decide who. But in the instance that you get some choice in the matter, or if you just see some red flags that it's just not a check you want to take, what are the things that founders should look out for to indicate that they're getting into a bad deal?
Yeah, I think it's all like a people process too, in the ways that I think about it. And so if I were an entrepreneur and I had the option of choosing investor A over investor B, I'd really think about like, who can really help me grow my business, and how do they provide coaching and feedback, and does their style of leadership and working with me resonate with how I want to build the culture of my business and grow. And so like in that instance, if investor A is really like paternalistic and telling you how to run your business and do this and do that, and and less partner oriented in terms of like coming to the table and wanting to figure out solutions together and be a part of the process. But investor B is more of that inclusive person that wants to be a part of the team and roll up their sleeves and see you succeed. And you know, your success is their success at the end of the day. That shared inclusive perspective is probably something that I'd want to align myself more to a little bit more. So that's kind of just the sentimental component of it, I guess. But then also thinking about from a practical standpoint, who can help me acquire customers, who can help me solve problems, who can help me find talent for the leadership team that I need to build out. I think those types of things become super important as well in terms of the trajectory and the success of the business. And a way to potentially mitigate some of those red flags is ask for referrals on the investor. See if they'll let you connect with some of their portfolio companies and get an understanding of like a reference check in that sense, because the investors are you know, in the diligence process probably doing the same on you as an entrepreneur in terms of getting to know you know, what is this person like to work with, will they be committed to building out this business, and it's, you know, if you're at the seed stage and you're working together to build out a business to exit, let's just say at Series D or Series E, that's like a 7-year relationship that you're getting into. And the more you're able to uncover those types of things up front, the better and more smooth that relationship can be over that period of time.
Absolutely. What do you wish founders knew more of or did differently when they're just starting their fundraise? First time they're talking to investors, if you could, you know, wave the magic wand and you'd never see X mistake again, what would it be?
Yeah, I think it would be more like not enough practice. And
Okay.
it goes full circle back to the conversation
Yep.
that we started with.
Yep.
You can tell when, like, you certainly don't want someone to be super pitchy when they're giving their pitch deck.
Yep.
And like, if it feels pitchy and rehearsed, then it's like a less natural conversation and it makes it harder to engage. But you can really tell when an entrepreneur knows his or her stuff in terms of like being ready for questions that come up. And you know, for me as an investor looking at an opportunity, I might be seeing it for the first time and I might ask a question that the entrepreneur has answered like 150 times.
Mm-hmm.
And so having gone through the process of answering that question 150 times has built the confidence in that entrepreneur to answer the one impression that I get on them by asking this question. And if they've gone through it that many times, you can kind of tell when someone has been there, done that in terms of practice versus kind of fumbling through an answer. And certainly there will be times where some investor asks some random question that you know, maybe you don't know. But the more and more you practice, the more and more you get in front of investors, the less and less surprises that you might experience in those types of pitches. And so for me, I think that would probably be my thought process in terms of what could be improved is just practicing before getting in front of institutional investors. And that's one of the things that accelerator programs do a really good job at, as far as connecting with individuals to go through pitches and provide feedback. And as we talked about, every pitch is an opportunity to get feedback and learn something new and different.
I think so I will give some practical feedback. You don't have to necessarily endorse this if you don't want, but if I'm getting a question 150 times across my pitches,
Yeah.
either it should be in my pitch deck or I should have an appendix if I don't actually want to be the one to bring it up. Like, so either it's not something I actually want to talk, if I want to talk about it, it'll be in the deck. And if it's not something I want to talk about, but I know the investor is going to bring it up, I will have an appendix slide that I can jump to show that investor that, yes, of course, I'm prepared to answer this question. And yes, I've thought about these things, but I just didn't want to bring it up in case you didn't notice or didn't want to bring it up.
That would be like plus one.
Yeah.
Yeah.
And then thinking about pitching specifically, we know, again, with the knowledge that most of our founders are early stage, we know that different investors value different things. When you are going through, that 5-minute pitch deck, that when you are paying attention to that, what are the things that you specifically are really hoping to hear or looking for? Go ahead. I won't put words in your mouth. You tell me.
Yeah, I think it depends on what context I'm looking at the business in. And so again, I think I'm fortunate to have worked across a bunch of different asset classes where I don't need everything to fit a venture model. I get interested in it nonetheless. Um, but typically you see venture pitch deck, so I'll just share it from a venture perspective. But you definitely like seeing businesses that are attacking real problems and real problems in very large markets. And from a market sizing standpoint, what are people willing to pay for that, and how many purchasers do you have in the market is a good top-down way to estimate what that might look like. And then certainly you can validate that through bottom-up analyses. But at the early stages, I think market size is really important, and understanding what the trajectory of that market looks like, is it growing? Is it relatively flat? And then understanding the industry structure within that market structure or that market size. Is it something new that you're launching that doesn't exist? And if that's the case, then why doesn't it exist? Why doesn't it exist? And is it really a problem? And why is no one tackling it? So I think those types of things are interesting to me. And then getting into more of the mechanics of the business, like what do your unit costs look like currently, and then what do your unit costs look like at scale, and what's that story of how you're going to get there at some point in time, and how well do you know your customers to understand what your growth strategy looks like. So like, which market or segment or niche of the market are you going to tackle first, and then how you're going to expand from there, and then how you're going to expand from there, and so on. And what does that do to your financial performance at the end of the day, and how do the numbers work out from that? That's the type of stuff that interests me. And the ability to tell that story and that narrative that kind of creates a hook that with each slide that you turn to, you're like, okay, this is getting more and more interesting. I'd love to have a chat with this entrepreneur and see what he or she is building out.
That's great. I am almost finished with my questions. I only have one or two more. If anyone from the audience has a question, now would be a great time to drop it in the chat, and we'll take a look and see if we can answer a few before we wrap things up. So my next question for you is more about venture broadly as a vehicle, and specifically thinking about kind of, let's say even up to like a 500K size check, your small checks, which that's what 500K is now, is a small check.
Right.
It's a tough place to be for venture. Like the economics of it make it a harder place. It makes it harder to write those size checks. And I'm curious, from your perspective, do you feel like that gap is appropriately filled by venture, or should we, as when we're discussing raising capital with early stage founders, should we even be thinking about just different vehicles at that point? Like, is venture the wrong vehicle at that point? I'd love your thoughts.
Yeah, and when you say a 500K check, are you thinking like the full round size?
Yes, that's what I'm picturing. Yes, like a 500K pre-seed, and just like finding that little bit of money. Whether you're going to cobble that together with a bunch of angels, or just like there's some
Yeah.
interesting just economic problems with a check that size right now.
Yeah, that's a really good question. I do think, and again, it depends on the focus of the venture firm. But typically with institutional investors, that might be a little too small, especially because at that point, you're you're either pre-product or pre-revenue, or somewhere around there, where you are getting some traction, but not enough to kind of warrant institutional interest in something. So for me, one of the gaps in the marketplace is, and and you've got the angel investors and syndicates that are there, but maybe those investors also need to be a little bit more risk taking, perhaps in terms of deploying capital to pre-revenue, pre-product companies. But again, each person should be managing their portfolio as they see fit based on risk and return characteristics. But that is a known gap, I would say, in the market. And I don't know if angels should be addressing that, but typically for those that are well off and more privileged, that's an opportunity to at least syndicate a part of that with friends and family capital. And for someone that has the right networks and the people that they're connected with that can write a number of 25K checks, those can add up to maybe half that round, and then you're able to bring in a couple of, let's just call them whale investors, that can fill out the rest of the round, knowing that it's not a full 500K check that they have to write. But it is a known gap in the space, and I hope that more investors are able to start tackling it.
I think it's an interesting space. Jay, I appreciate the time. I think that is everything. I don't see any questions in that. So I appreciate that. Thanks for coming. Is there anything else that you want to say? Anything else you want to get off your chest? Anything you feel like I missed that is worth talking about?
Yeah, I thought you did a great job of asking really thoughtful and insightful questions, and hopefully, my perspective added to some of the other people that you previously interviewed. I think for me it's just one, having the chance to pay it forward and helping out entrepreneurs in whatever way that I can, and two, just being super inclusive with the networks that we're building and the things that we're doing, because it has traditionally been more of that exclusive type of network where you need to belong to these institutions or run in these circles to kind of get a chance to have a seat at the table. I think that barrier is slowly starting to break and quickly starting to break in some sense too. But I think that intentional inclusion is something that we all kind of have to keep working on, and something that I'm certainly trying my best to get better at too.
I love it. I'm going to try to incorporate intentional inclusion as part of my mantra.
Yeah.
Thank you again, Jay. Our chat next month is going to be with Sam Louie, who I actually see is here enjoying the show. Sam's from Techstars, and she is going to be giving us all the important, cool information about what's going on with Techstars and everything cool that they have going on. This conversation is going to live on our content hub, which is uncrowd.webflow.io. So once we get the video up, it will be in there with a bunch of other investor chats and founder resources. And again, we're definitely going to dive into founder resources with Sam. There's some amazing stuff that Techstars has to offer. If anyone wants to contribute anything, we're always open to contributions. You can email Adam, don't email me. And of course, join Uncrowd. We'd love to have you on there. We're working every day to connect founders with investors. So thank you again to Jay. I appreciate it. And everybody have a great night.
Thanks, Forrest.